Good evening, ladies and gentlemen, and welcome to another episode with Axis Mutual Fund. We at Axis Mutual Fund strive to come back to you week after week with webinars to engage you, to understand the likes and dislikes of our investors, and to help you make better investment decisions. So today we have with us Shikha, who is a senior product manager with Axis Mutual Fund, and brings a diverse experience across the equity market and the equity spectrum. So before we get into Shikha and the whole topic, we're actually presenting a topic which is very close to us as a fund house. This is a concept which has been an engine of our growth, and therefore we are here. We thought a Friday evening is always a good time to spend with our esteemed investors. So without further ado, Shikha, over to you. Let's get started.
Yeah. Thank you, Siddhant, and very good afternoon, everyone. Thank you so much for joining us today. So we'll be discussing the large cap fund today. We have Axis Blue Chip in the category, and I would like to explain it from the very start of how what is the large cap fund and how do we place it, what is our strategy, and was it a good time and compared to the market views on it. To start with, what is large cap as a stock? So, if it's a listed stock in India, is ranked between 1 to 100 based on the full market capitalization, then it's called a large cap stock. And a large cap fund or a large cap category are the one which predominantly invest in those large cap stocks. So when I say predominantly, so it's per SEBI, it is 80%, at least 80% into it. So we have Axis Blue Chip Fund here, which invest at least 80% into the large cap fund. So I'll just share my presentation with you to explain you the further details.
Maybe,
So
Shikha, before
one,
we get into the details, let's also probably, once you explain blue chip as a category, large cap as a category, let's also take 2 minutes to just explain an overall macro of where we are in the market. Because we've seen another a red day at the markets today, so maybe that'll help us set some more context.
sure. So from this month onwards, we are seeing that after a long time, continuously the market is getting bearish. But if we look at India as an outlook, it remains healthy, largely on the backdrop of strong GDP growth. The inflation is under control for us, and the capex, which we say the government spending. Because of the election, there was not much of spending in the first half of the financial year, but now those spending has to be done in the second half of the year. So we expect that rising capex, which will ultimately help in a boosting of the economy, and certain segments will get more money to infuse in the economy. Then we can all see that there is a fiscal and CAD is quite comfortable with us. So overall, from a market perspective or from a macro perspective, India remains in a good position or in a healthy position. Even if we compare with the global market or we compare with the emerging market only, we still are quite attractive from the positioning itself. But I think the point of concern which market is taking is the demand slowdown is broadening, wherever GDP is still doing good, but the corporate top line and the exports are actually slowing down, and that's where the main concerns are. But I think overall, from a perspective, even there's a India is in a position as the fastest growing economy, and because of the good monsoons, we believe that the consumption sector of the economy will do well, and because of this rising capex or more government spending, a part of the investment will also do well. So these are the two segments which are positive, though earnings have slightly slowed down, but from overall perspective of macros, and we standing in a good position compared to the global, we still believe that we are in a good shape, especially from the supply side, where we talk about supply side means the balance sheets, they're still in good shape, so the limited downside risk is there, and we believe that the continuous flow in the market will boost the market again. But yes, that's not going to be like an year back scenario when the entire market is doing well. Now we're going to move towards the segments which have not done well, or where the valuations are slightly lower, and that's the segment which is going to, in our opinion or in our view, will do well. And there are certain segments which might have done or which have actually done well, might not be as benefited, or compared to the other sectors might not do it well. So there's a sector rotation we expect in the market, And we have also positioned ourselves in line with that, saying that not the entire market might do well, but there are segments, selected pockets where the valuations will be attractive, where the earnings are good, and market will reward them. So, on this background, I think I'll take it to why we are positioned for the large cap and why we are talking about the blue chip right now. Because blue chip are the stocks which have the proven business models, especially from have a long-term track records, have seen the various business segments. They have various diversifications there. From the market leader perspective, also they have more market shares. They have sizable, penetrable companies, and typically they usually have strong corporate governance as well. So, from a long-term perspective, this are the investments which are better positioned to withstand the economic turmoil there. So that's why I think blue chip are well positioned right now. Blue chip stocks are well positioned right now. Also, from the perspective of risk reward or risk return perspective, what we can see that the competitive advantage which a large cap company has, because large caps usually cover more than 60% of the market cap of all the listed companies, and they have a competitive advantage because of the higher capital efficiencies or the lower margin due to high scale of operations, because they're a big company, they have high scale operations there. So from this perspective, we believe they are more stable. And so when there's a difficult time in the market, when we see the bearish phase or the higher volatility, large cap tends to do really well. For example, if on the screen you can see there's a return profile between a large, mid, and a small cap. So in the downside, if you see, large cap has fallen historically less than the mid and small cap space. Though when the market shoots up, the mid and small cap tend to perform better, like we have seen in last 1.5 2 years. But whenever there is a difficult time, large cap actually end up giving you more stable returns. So that is how history has been, showing the results. Because they are more stable, they have low volatility, the drawdown there is lower. This could be a right time to have certain allocation, sort of positioning towards a large cap, and this is coming from the view which we have shared earlier. Now, having said that, the lower volatility, I would also like to share this data where in the large cap, which is the burgundy color, and which is the mid and small cap. So if you look at from 2015 onwards perspective, you will see that the small cap has fallen more, followed by the mid cap, and the large cap has a lower maximum drawdown. It means that the cushioning is huge there across last 10 years period. And even if we look at from different market condition perspective, or from a perspective like if I look at in a flat market or in a narrow market or in a difficult time like COVID or rising markets, large cap has gone through all these phases. They, being the big company, are able to sustain the difficult times. Like in the COVID times, when many companies suffered, large cap companies suffered less because they had a vaster business, they have more capital to infuse, and they can withstand this short term losses which the company is occurring because of any reasons like COVID or the economic turnaround or economic slowdown. So they have more stable as a company, and ultimately that's why the large cap funds are more stable. Like for example, in a flat market or a narrow market, largely large cap either end up outperforming or giving you positive returns, or give you lesser negative returns. It means there are cushions built up in this during the tough time of the market conditions. They provide a huge cushion to your portfolio. And when the markets are on the rising phases, usually mid and small cap outperform them. But this is from a broader market perspective. But if one look at an active allocations, or why not buying the entire top 100 but actively choosing those company, one can actually do a better performance. For example, if BSC 100 in the last 10 years, like from 2014 to 2024, in the last 10 years has given you almost 15%, that is 14.5% CAGR return. So your 1 crore has gone to 3.9 crores. But if I would have done an active allocation towards it or invested in an active fund, then those top quartile ones have actually given a 30% CAGR during the same period, or your 1 crore would have gone to 13.8%. And if someone has chosen a stock, a large cap stock, which is in the bottom quartile, then it would have gone down to as low as 6% CAGR. It means even in the large cap, it is important to choose the quality stock. It is important to choose a stock which will end up doing well. So it's not the broader market segment which one need to look at. It's actually the stock wise allocation or the active allocation, which also matters a lot. Now, in the context of the current market view, we also believe that this is a time where the stock based view will do more than the sector based view. So from last, from last 2 years, what is happening is the sector by sector, the entire sector is doing well. So they are mostly 90% of the market is doing well, kind of. But now, in the scenario which we are today, we believe that it's going to be very sector specific stories. It's going to be a bottoms up approach which is going to work in the market, and not the entire broader market or the momentum approach which might work. Now, coming to, I think, Siddhant, like you asked on the market-based view, and one point I would like to touch deeply on that is the valuation, because I think that's the biggest concern, and which every investor might be asking right now, that India is quite overvalued. Then whether one should stay invested, one should take money out, or what needs to be done here. So from the valuation perspective, so across the market, the valuations is quite high. You take a large cap, you take a mid cap, or you take a small cap. But large cap compared to the mid and small cap is not that highly valued. So from a 5 years, 10 years perspective, if you can see, the valuations of Nifty 100 index PE is slightly higher than it's a 5 and a 10 years average, but it's close to its 15-year average PE. And if I compare it with a small cap or a mid cap, they are much more overvalued than the large cap space. So, from a valuation perspective, the large cap remains the attractive segment, and especially in the scenario where the interest rates are elevated right now, and market is generally gets valuation oriented and reward the cheaper stocks here. So when I take the cheaper stocks, it's mostly the large cap segment which is now relatively cheaper compared to the mid and small cap. So that is, I we believe that market is gonna reward more, or market will have larger flow towards the large cap segments there. So, broadly, from the large cap perspective, this is where we believe that entire large cap or the active funds are positioned. But if I have to specifically talk about the Axis Blue Chip Fund, which is a flagship fund, there are few things which I would like to highlight here. Is one, on how do we manage the fund, because we believe in quality and growth, right? So when I talk about quality and growth as an approach of Axis, or as an investment philosophy of the Axis, what is quality to us is defined into two parameters. One is a quantitative factors, two is your qualitative factors. One, from a quantitative factors, what a quality is a more stable cash flows, your lower debt to equity ratios, or your strong return metrics there. And apart from that, we also look in a company how the management is, if the management pedigree is strong, if there's a sustainable long-term business model that the company have, where there's a strong internal controls, how transparency of operation works. So all these things define that whether a company is quality or not. And from a growth perspective, so if a company is growth, when it is delivering higher growth than the your company, than the economy, right? And as well as the fundamental factors like ROE and ROCEs are higher than the cost of capital. So these are the few parameters which helps defining the growth of a company. And we believe that the quality with growth, which is the Access philosophy, is what is embedded in the Access Blue Chip Fund as well. So the fund focus on similar parameters there, where we talk about the stock corporate governance, we talk about the management pedigree, we talk about the business models of the company, how the growth is there, whether the cash flows and the ROE are good in the sense, are we it's more than the last quarter, more than the last year, is it beating the other companies? So all these parameters have been considered here. And we believe in being true to label. So hence, when we said that we are predominantly large cap, you will see that more than 80% will be we are invested in large cap by SEBI norms. And if you look at our portfolio, also you will see that for not more than 4% are there in mid cap, and we are largely more than 90% in the large cap. So we have remained true to label there. Two, we have done risk management. Risk management is embedded in the investment process itself, where we look at the relative liquidity of the portfolio, we look at the target volatility compared to the benchmark. So that's how we try and manage the risk there. Also, we believe in bottoms up stock picking approach. So when I say bottoms up stock picking approach, it means that we look at the potential of individual stocks from a fundamental perspectives. Stocks are selected in a portfolio based on their ability to grow earnings on a sustainable basis, while maintaining a highly liquid and a risk managed profile. So that is how we actually pick up a stock there. Then boiling down to the core approach, or how do we focus, we divide the portfolio into two parameters. One is on the leaders, second is on the challengers. So when I talk about the leaders, leaders are usually the ones which operates in a company with a relative strong corporate governance, make them more stable. They are more secular growth, and they have the higher market shares, or the leader in the market shares. So those are the leaders. So since they are the leaders, they have advantage of what we talked earlier, competitive advantages of low marginal cost, and they are more stable, and they can withstand the turmoils because they are leader, they have a higher market share there. So those provide the stability to the fund. And then there is the allocation towards the challengers. So challengers are the one which are trying to gain the market shares, or they have some competitive advantages due to which they are gaining more shares. So it could be a cost advantage, it could be a product differentiation, so some kind of advantage which is boiling it down or making it them to moving towards the leaders or challenging those leaders. And those are the one which actually create more alpha into the fund. So that's how we manage the fund. We buy leaders and we buy challengers, and we create more stable return in the portfolio. And from the fundamental perspective of the portfolio, so because we say ours of quality, so the valuation are high across the market. But if you look at the earnings or ROE, so those are the parameters. So if you're high valued, but if your earnings are good, or your EPS is good and your ROE is good, that's where we call it a growth, quality with growth, and that's how the position of the portfolio is also there. So if I compare with the benchmark, the fund has a higher ROE, the fund has a higher EPS as well. So it shows the quality of fundamental quality of the portfolio, that whatever we buy, we have a strong conviction in. Those might be higher PE stock because of the growth tilt towards the company, but at the same time they have a potential to deliver the better because of the higher ROE and higher EPS growth. um, from the portfolio perspective, so like I mentioned earlier, that we are more true to label. So if I have to look at the large and the mid cap allocation, you will see the burgundy color is the large cap allocation. We have recently slightly increased the mid cap allocation. This was across 3.4 to 3.6% in the mid cap. But these are one or two fundamental reasons behind it. One, we have picked few mid cap stocks because in certain sectors, the good companies are in mid cap, or what we have bought something which was large cap, but due to the market cap shift, they have balled down towards the mid cap. But we still believe those are good companies. However, they are minute percent there, and we have large allocation towards, or predominantly allocation towards, the large cap. So it's a true to label fund for us. If I talk about the portfolio, so you will see that the portfolio, we have increased the breadth of the portfolio. We have made the portfolios quite granular there. We have done some sector turns also there. So like I mentioned earlier in the market outlook, that we believe that there will be sector churn, and the laggards might are likely to lead going forward. So the sectors in the consumptions, the private banks, insurance, IT are the segments which we believe will do well, and that's how the fund has been positioned, and it has increased its allocation towards those particular segments. From a standard deviation perspectives, what you will see, so standard deviation is something from a 3 years perspective. If I look at the portfolio from a 3 years, what is the deviation, or what is the standard, what is the volatility of the portfolio, is something which you can judge. So volatility of the portfolio is somewhat equal to the benchmark, but the beta of the portfolio is lower than the benchmark. What does the beta tell us? Beta tell us that if benchmark, the relationship with the benchmark, right? So if a benchmark fall by 1%, then how much the fund will fall by, or how is the fund correlated to the benchmark? So if the beta is closer to 1, it means you are highly linked with benchmark. And if the beta is less than 1, then it means you're slightly less related to the benchmark or less correlated to the benchmark. So beta of the fund is at this point 0.95 of the fund. Because it's a large cap and we have increased the breadth, it will be slightly higher. But as much as we take the active call, the beta gets lower. So I think that's from the fund perspective of how we are managing this fund. This fund is managed by Shreyash Diwalkar, who is the head of equity. As a second fund manager is Ashish Nayak, and then there's a Krishna for foreign securities. The benchmark for the fund is BSE 100 TRI. That comprises of the top 100 companies by the market cap wise. So I think I would so that let's take the questions. I think we will be able to address more concern
Yeah,
if we understand what investor wants to hear.
definitely, Shikha. I think, thank you. I think you were extremely detail oriented in the presentation, and we have a few questions that have come up. But I think before we get into the questions, I have one question that, we, by virtue of being in this sector and by, speaking to so many, folks in the industry, very often hear this, this terminology that says small and mid cap stocks are overvalued. The PE is high, etc. And so therefore it's the right time to perhaps invest to diversify into large caps. So what are your views? So maybe if you could help explain to our investors, what does this mean? What does high valuation in a mid and small cap stocks mean, and maybe in context to large caps?
Okay. See, so when we talk about valuations, uh, see, whenever there's a price, valuation is what your price to earnings. So it compares your earnings of the company with your price, right? So when the earnings are not expanding that much, but the prices are increasing a lot, it says your companies are overvalued. Okay, so this P ratios gives you an indication of overvaluations. Now, these overvaluations can be of multiple reasons. Maybe the earnings are not reflecting right now, but in future you expect these companies to do well. So usually the growth-oriented companies have higher PE. But at this time, we can see the entire market being overvalued. And I say, and I should not use the word entire, but broadly, most of the market is overvalued. Now, with mid and small cap, which have done very well in last 1.5 2 years, uh, their prices have gone really up. But if you see the results, and if you see the current season earning seasons, or if you see the last earning seasons also, the earnings have slightly muted, or it's not as high it was like an year back. So that's why we are saying that market is really overvalued, where your earnings are not able to justify the price, right? Where mid and small cap prices have really gone up, their valuations are very high. But this valuation story we have been talking about for 1 year now. So, a year back also, we believe that the valuations are high, and today also we believe that the valuations are very high. So, does it mean that mid and small cap will not work? The answer is no, because there are other factors than this which plays into role. One, the flows in the market also plays a big role. So, Indian market, which was earlier dominated more by FIIs, and we had lot of influence because of that. Whenever FI moved out of a market, have seen the drastic fall in the Indian market. But this time, the retail investors or the DIIs has played a big role. So when they infuse the money, even when the FII pulled out, the market has seen like very short period of very short bearish period, or rather, let's say, from a long term perspective, these 3 years were really good for us. But now, saying that switch to large cap is more from the perspective that earnings have muted. Now, when the earnings have muted, it's better to go towards the companies which are more stable and which, in an economic turmoil situation, can provide you more stability. So that's why the view has moved more towards the large cap. But yes, the entire market is overvalued, and from that context, one needs to take a very conscious call on, where to switch. And a lot of market has been thinking about moving the money out of mid and small cap, and we are getting very conscious on the point of liquidity as well, because these are small companies. So if one big trade can cause concern on the liquidity of the stock. So small cap create that point of concern there. So that's why there are a couple of concerns in the market. But since we are doing good from a macro perspectives, we are relatively compared to the global market post wealth attractive. We believe that moving towards the large cap can give you some stability in the portfolio and in the current situation.
Yeah, thank you. I think that's a very interesting insight. So maybe Shika, a slight left field question. Now, there are a couple of questions here that talk about the consumption story. Now, we've seen the news recently. We've read about how Q3 traditionally is where India's consumption trend picks up. So, how do you think the consumption story plays out with the large cap stocks?
See, consumption story started playing out when the rural economy started picking up, and the monsoons were really good. So this is when the consumption story has actually started picking up. But when I talk about consumption, it could be the FMCG or durable consumer durables or consumer services sectors. See, they have good allocations or large allocation towards the large cap. So consumption is slightly large cap dominated there. So, from a prospect that whether the consumption will keep on doing well, the answer is yes, is expected given on the macros of the economy. And this is a segment which have actually hit a lot. So, FMCGs have not done well from compared to the market, have not done well, which has recently started picking up. The rural economy put a lot of the two wheelers get really rewarded when the rural economy do well. So those are the segments which you believe will do well, and yes, they have huge allocation from the large cap stocks. So that's why they have more tilt towards the large cap. So yes, the consumption story will play out, and the maximum benefit, what in my opinion, might go towards the large cap stocks there.
I think that's a very interesting insight. I think because recently there was also a stat that India is now the two-wheeler capital of the world. So yes, I think there is still a lot of consumption potential, and in order to achieve our full potential, we should move from two to four-wheelers. But that was on a lighter note. There's another couple of very serious questions. I think these questions are from our the investors who've been with us for a while. So the gentleman asks, with the recent changes in leadership, how has management approach to Axis Blue Chip Fund evolved? And what can investors expect in terms of strategy and performance? So maybe if you'd want to take a couple of minutes and break down the question.
Okay, from the change in the management, so see, it's a long backstory now. It's almost been an year that there has been change. There's a new CIO who joined. There's a new CEO who joined us. There's a new who has joined us. Compliance head has joined us. So the entire management has changed, and we have strengthened our process. I think almost a year and a half back. Itself that the process have been strengthened, how we got think we the changes in the funds have been implemented. What we have done from a fund management perspective is that because we had a slightly concentrated allocation, especially in the blue chip fund, slightly concentrated allocation towards the stock, and which has hit the stuff fund a lot, because when those stock didn't did well, the fund took an hit. We have actually diversified the fund. So the number of stocks have increased in the portfolio. The number of sector exposures have increased in the portfolio. So if I have to give you a ballpark figure, like in August 22, the fund has 37 stocks in the blue chip fund, and now it has gone up to like I think 54, 55 stocks. So number of stocks have increased. The sectors which were earlier not invested because of the reason, maybe because they have not flourished that well, or because maybe they didn't qualify into quality, but we have considered them looking at the changes in the market, looking at those sectors being evolved. So now the sectors are from 19 has also moved down to some 28, 29 stocks. The concentration level has come down. So like top three sectors, which was contributing to almost 50% to 2 years back, now is contributing to 40%, kind of. This number will look, I know people will have concern on 40%, but if you look at the index also, so financial services itself comprises of 30% for the index. So because that's a big sector, the top three allocation looks quite higher, but we have actually reduced the concentration there also. So what we have tried to create here is create more granular portfolio and spread the alpha in such a way that alpha is not coming from some couple of stocks, but it's actually coming from broader stocks, so that it remains in the fund. and it creates your long-term wealth creation. So that are the changes or the fund positioning we have done in the fund. From the investment approach or from the investment philosophy perspective, we still believe that quality outperform in the longer run. So even if you see in the, I think from like 3 4 months now, the quality have started outperforming or picked up the performance there. And same we can see that soon that will reflect in the fund as well, because we believe in quality with growth. And this philosophy has proved itself time and again, saying that there could be a period when, and every style has a period, like every style goes through a cycle, and quality also goes through a cycle. So we have gone through that cycle of quality, but we believe that in longer run quality ends up outperforming, and we're going to stick to our philosophy as it has proved that time and again that it can do well when there's a economic turnaround or when there is a turmoil happening in the economy.
Yeah, I think that you hit the nail on the head, right? Where we have a strong conviction in the investment style and we'll stick to that. I think that's a great way to put it. I think, Shika, very interestingly, I think we have a lot of first-time investors also who joined in. So there's a couple of questions. Maybe if we can answer these. These are quite interesting, especially I think these are younger lot of investors. So welcome aboard. So first question is, can you please define large cap companies and what are the key factors one should consider before investing in a large cap fund?
Okay, so large cap companies, like I said, so SEBI, what does it on market cap basis, rank the companies. So top 500 companies make you an 500 index. It can be BSE 500 or NSE 500. And the top 100 ranked based on the market cap, full market cap, are called as a large cap companies. So 1 to 100 is large cap. Then there's a mid cap, then there's a small cap. So 250 and below are small cap, and 100 to 250, that is total of 150 stocks are mid cap stocks. So focusing on the large cap stocks, 1 to 100, what do you look into this? See, usually large cap stocks, being the top of the economy or being the big companies, are more stable. But how to choose them, or let's say how to choose a large cap fund? One invest in large cap to get the stability in the portfolio, or to to get the benefit of creating a cushion in an investor's overall portfolio. So look for stability, look for lower standard deviation, and look for a company which is truly large cap. So though the SEBI mandate is 80%, if you are like allocating because you might already have a mid cap stock, a mid cap fund in your, or a small cap fund in your portfolio, and if you're coming to large cap, stick to the one which is actually have more than 90% of the large cap. So that's our more true to label companies, true to label funds. So look for that one. Look for lower volatility in the fund. Look for the lower drawdown in the fund. So I think these are the parameters. Use it as a cushion. Use it as a more stabler returns, and attach it to your long-term wealth creation. So this is the idea of, I think, large cap.
Thanks. I think even I think this was a great question to revise a few concepts for me also. Okay. So I think Shika, we have a couple of questions left, so we'll go through them. This gentleman asks, what are the top 5 sectors within the large cap stock universe? I think you touched upon it during your presentation, but still, maybe if you could quickly go through it once.
See, if I talk about large cap as a overall sector, so I think financial services make a good 30% of it, and then IT, FMCG, oil, other top ones there. Talking about our fund here, see, we believe that, of course, in line with the benchmark, since this is how the benchmark is, bank, IT, automobiles, retail, are the some of the top sectors which we are also top sectors of Access Blue Chip Fund, and we have higher allocation towards them, and that's somewhat in line with the benchmark also, because the inclination is towards that. I think you will find a lot of the funds also in line with it. But since we believe that there's a sector turnaround happening, so you will see some churn. So like you will see some increase in that. You if you compare it in last few months portfolios, you will already see some increase in IT, software segments, some increase in the retailing segments. So this is how we are positioning our funds and changing the sector allocation there.
Right, thank you. And we have, unfortunately, I think we have a lot of more questions left. So I think I'd request the ladies and gentlemen who've joined. So feel free to visit our website and you can write into us. You can reach out to us on social media. We'll be happy to answer as many queries there. But due to the paucity of time, I think we'll take one more question, Shikha. And that talks about what is your outlook for the Indian equity market over the next 1 to 3 years? And how does this influence your strategy for Axis Blue Chip Fund? I think this is a very important question also from a geopolitical lens, right? We've seen a lot of volatility. So the war is still on in Europe. You have day in and day out volatility in the Middle East. So, what are your views on that?
See, yes, the concerns on because of the geopolitical, the risk has been there. It's not today. It's been there for almost more, like the Russia Ukraine is almost what 2 years, if I'm not wrong, right? Then the recent Middle East concerns, which just shoot up suddenly, then nothing happens, and then another concern happens. So, see, these are the parameters which influence the entire global market. But what we have seen in the last 2 years also, okay, Indian economy or Indian stock market remains strong because of good macros which we have. Some sectors get influenced because of the exports or the external factors which impact us, but overall, if you look at our economy itself, our GDP it's quite well, though it has come down. We are in line with the RBI projections there. Two, inflations have come down quite a bit for us. Third, the concept of make in India, focusing on exports, have worked well for us. Third, the RBI, which is trying to manage the rupee in such a way that we do not depreciate drastically, which is actually helping us out. And the huge amount of reserves which we keep, RBI keeps, is something which works as a shield. Even if there's a geopolitical concern, the rupee can be managed there. So rupee becomes a big concern because when you try to import oils, your cat goes for a toss, right? And then your rupee depreciates a lot. Your exports become expensive. Sorry, your imports becomes very expensive. So that's why the comfort which RBI is giving us, the comfort that the internal rates that we still are at a higher rate, and there could be a rate cut, we could be in line with the global market, and our GDP doing well, inflation's in control. The overall corporates, though the earnings have come down, but our corporates from a perspective are still doing well. So we do not see major concerns there, though there could be a short-term impact, but we do not see a major concern. We still stand strong, kind of. But what one needs to look from an equity perspective is now, okay, where are the pockets which will do well? Because not every pocket will do well going forward here. So one needs to look at the selective pockets. One needs to have a bottoms up approach now, ki whether those companies can withstand if any influence is there from the global tensions, or from fall in the GDP coming down, or the outflows of the money. If DIA also reduce the money here, then FII we can see negative this month. So those are the concerns which only selected segments can take up. So get more stock specific. I think that getting more stock specific is one of the approach. It's not just in blue chip but across the funds which we are getting. Bottoms up has been our style, and we stick to it because that's where we believe the ultimately. You can choose good companies, because if you go by sector down approach, you might get sail through the sector cycle. But if you go through a bottoms up approach, it gives you a better quality result. So since we are quality with growth, we stick with the bottoms up approach. So these are some of the styles which are access style also, and which we remain stand on, and it's across the funds including blue chip we have implemented, and we stick to them because that it's actually helped us out earlier, and we believe these other strategies work well from a fund management perspective.
All right. Thank you, Shikha. I think we've unfortunately run out of time. So I think thank you, Shikha. You've been an incredible speaker today. You've gotten into the depth of Axis Blue Chip Fund, and we've answered a few very pertinent questions, especially from our existing investors. And we've also answered a few questions to help our new investors to get into the investing space. So with that, I think we'd like to thank the ladies and gentlemen who've joined us this Friday evening. We wish you a great weekend. So, to know more about Axis Blue Chip Fund, about any of our products, you please visit axismf.com, or you can download our mobile app from the Google Play or from the Apple App Store. And happy investing.
Yeah, thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.